Welcome back, everybody. We're almost in October. We're nearing the end of all of the forbearance periods that have been given due to the coronavirus. And today we're going to go over the difference between a loan modification and a forbearance. Now, there's a lot of noise out there talking about what loan modifications are, what forbearances are, terms of forbearance, repayment plans. So today we're going to get into the actual facts based on real life scenarios. So what we're going to first do is pull up right now an example of a loan and discuss the breakdown of what each represents. So let's just say, for example, you have a $400,000 mortgage. That's your current loan balance. Your payment due monthly, which includes principal, interest, taxes, and insurances, comes out to $3,000 a month right here. All right. So every month you make that same payment. Now, let's say for whatever reason, you still haven't made September's payment. You're able to call up the bank and ask for a forbearance, and hopefully they're going to grant it to you. I've heard of forbearances going anywhere from 3 to 6 months. All right. That's a very key number right there that basically buys you time to not have to pay your mortgage. So whether you lost your job, whether you have a hardship, whether you have to stay home because your kids are being homeschooled, whatever it is, tell this all to the bank. If you tell this to the bank and explain your hardship, they're more likely to give you 6 months. They may even just give you a 3-month introductory phase, and then maybe extend it to 6 months. But right now, the average time for a forbearance is 3 months. So what is a forbearance? So a forbearance is basically just a deferment of your payments. So it doesn't mean you don't ever have to pay it. It just means that they may put your mortgage on pause for 1, 2, 3, 4, 5, or 6 months. So let's say, for example, you owe $400,000 and you get a 3-month forbearance. Now you're going to owe $409,000, right? Now, what's in question is going to be the $9,000 that you haven't paid. Sometimes banks make you pay 4 payments in one shot, all right? So after they give you the ability to not make payments for 3 months, on month 4, you have to make 4 payments. So 3,000 times 4 is $12,000. So in this case, you would get no payment due in September, October, November. Come December 1st, you owe $12,000. Now, this is great for people that are maybe in between jobs, had unforeseen expenses, got laid off, whatever, but you know you have money coming in, or you have money in a savings account that you could access in a couple months. Maybe you have a CD that's going to mature. Maybe you have an inheritance coming. Whatever the case, a bonus. This is a great option for you, and you have to make sure you get this in writing. All right. So never agree to any type of loan modification or forbearance unless it's in writing and presented to you, and obviously have a professional in finance or your attorney review anything that you're signing. Now, what a lot of people are doing is going into forbearance, and at month 4, they don't have the $12,000, or they're still unemployed, whatever it is. They can't make this payment. At this point, then the bank tells you to get a loan modification. Now, what they also don't tell you is a loan modification bangs up your credit. Now, if you don't make that payment on month 4, forbearance does not impact your credit negatively. It just has a note on your mortgage saying that you did a forbearance. That's it. It doesn't say you missed payments. However, loan modification, if you don't make this payment in month 4, they're going to mark you 120 days late on your credit. So you're going to go from having no lates because you had a forbearance to 4 lates in a row overnight, and your score could drop hundreds of points just because of this. Now, loan modification usually takes months to approve. All right. You have to submit financial documents, assets, income documents, a hardship letter. It's a very, very tedious process. And the majority of people that are working on the bank's end aren't educated, aren't smart, don't know mortgages, don't know lending, and they just tell you whatever just to tell you. It's a very, very bad process. And I believe that we do need some type of reform in this particular division, especially with the coronavirus going on right now. You don't have experts giving advice. You don't have experts helping you, hand-holding you. Ideally, you want to avoid a loan modification and a forbearance, but sometimes you're going to be put in positions in life where you have to do this, right? And I come from the camp of, hey, if the bank's going to tell you that you don't have to make your payments for 3 months, they're giving you that permission, and it's not going to impact your credit. take it, especially if the property is vacant or, again, you have unforeseen life circumstances happen. Now, when you go through a loan modification, now let's just say, for example, for whatever reason, this gets taken care of in this 30-day window after your 3 or 4 payments are due. Let's just say now you have a total amount due of $412,000. They may modify your loan to keep it simple. Let's say a 40-year mortgage at 2%, right? And as long as you make your payment on time, your payment will always stay at 2%. Now, where the problem comes in is if you miss a payment, okay? So if you miss a payment after you do a loan modification, your mortgage can balloon. Now, many of you are probably thinking of hot air balloons or balloons at kids' birthday parties. Not those types of balloons. What a balloon is your whole balance is due. So even if you try and make a payment, they may not accept your payment. They may send your payment back. They may reject it. Some may take it and just start paying down the balance of the loan, but they're basically calling your mortgage due because you're in default. I don't see this happening because I think everybody, based on what's going on and based on what I'm hearing, there's going to be a lot of scenarios like this. And obviously from a legal standpoint, executive orders, I don't see people, really getting truly hurt from this immediately. Maybe 18 months from now, 24 months from now, when the courts open back up, yes, but this is not on the court's priority list of kicking people out of their homes or helping the banks out. Let me just tell you that. So if you miss a payment on your loan modification, which is the absolute worst thing you could do, you could then try and remodify it again. But again, strike 2. It's really strike 3 against you, right? You had the forbearance, you had the loan modification, you messed up both of those. There's no guarantee that you're going to get, an opportunity for strike 3. So what I would recommend everybody doing is really speaking to somebody to help you figure out what your best option is, what your options are, and then selecting an option that your repayment ability is going to be concrete. The worst thing that could happen is you enter into an agreement with the bank and then not honor the agreement because now they have no incentive to help you. Again, they also have a lot of people working for the bank that aren't here to help you at all. So I know it's an emotional topic. It could be embarrassing. You could obviously have your pride on the line, but there's nothing more important right now than dealing with experts that know the ins and outs of modifications and forbearances. Now, real quick, if we talk about just forbearances in general, if you did a forbearance and you are coming out of your forbearance for October, let's say. Now, let's say the bank told you you don't have to make your, forbearance, your last 3 payments until the end of the loan. That's fine. That could be the agreement. However, in order to refinance and take advantage of today's interest rates under 3%, which are incredibly low, all right? They're about 2.5 to 2.75% right now on a 30-year fixed. You need to remove the forbearance and come current. So even though the bank tells you, hey, you don't have to pay these 3 payments until, 30 years from now or 20 years from now, that's true. But you cannot refinance until you catch up on those payments. So if you did 3 payments and you're coming out in October, you must make 4 payments. Well, you can make 1 payment, but 4 months worth of payments. If you make those 4 payments, right? 4 payments, you're now eligible to refinance your loan. So again, this is really a business decision, a personal decision. I'm happy to give you the guidance, but these are the facts based on Fannie Mae and Freddie Mac's rules right now. A lot of people don't like it, and I get it. What I've seen is the majority of people that did forbearances have the money in the bank. I think that's going to be where the problem is. So people just chose not to make the payments for 3 months, which is fine. Now they want to refinance at 2.5%. You just told the bank that you couldn't make the payments. Now you want to refinance. I mean, if someone's not making payments, they're probably not going to continue making payments, or they can't make payments. So that's why they require you to come out of the forbearance, come due on your mortgage, pay the past due amount, and become eligible to refinance. Now, I want to read to you an excerpt from a loan modification I'm working on for a client. It's actually called a deferral modification, a little nuance there. So a payment deferral brings your mortgage current and delays repayment of certain past due monthly principal and interest payments. You will be responsible for paying the past due amounts upon the maturity date of the mortgage or earlier upon the sale or transfer of the property, refinance, or payoff of the interest-bearing upfront unpaid principal balance. Interest will not be charged on the total past due principal and interest payments of the amount deferred. The payment deferral will not change any other terms of your mortgage. So in this instance, they say, okay, you have a $400,000 loan. Your payment's $3,000 a month. Let's say you had 3 payments that were delinquent. So now you owe $9,000. So now you have a new mortgage of $409,000, but you're still paying $3,000 a month, right? So this is a favorable option, in my opinion. If you miss the 3 payments, it's called putting the past due payments on the back end of the loan. That means that you're just adding that to the amount, but your payment's still remaining the same. You're still going to pay off your mortgage in 30 years or 20 years, whatever your actual loan term was. I'm a very big fan of this if you're offered this. However, there's a potential that this does impact your credit. So we need to speak about what the options are, what the pros are, what the cons are, and really how to get you in the best position. So if anybody has any questions, reach out anytime. Be sure to look up in the corner that way. You'll see we are launching our company coming up very soon called Reverify. I really think that it's going to be a game changer. So be sure to go to reverify.com, sign up for our launch. Make sure you go follow me on Instagram in the bottom. I always get this wrong. In the bottom, that corner right there. Check it out. Hopefully you'll find some insightful tips. And remember, before you make any decision, please speak to the experts. Don't Google who's an expert. Ask for a referral. Hopefully this video gives you some tips. Hopefully you consider me an expert at this point. But again, get the accurate information so you don't make a decision that could jeopardize the next 36 months of your life negatively. Other than that, wish you well. And remember, if you can make a payment, make a payment.